Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research. With me today is David Blake, CMT, here to discuss what happened in the market last week and what we should look for as we continue into this week's market. David, how are you today?
I'm doing well, thank you. We had a third week of gains last week, actually strong gains for the last 2 weeks, in fact. We had a lot of the major averages to break out the new highs. And basically, we're still trading off these headlines with the U.S. and Iran war. And then we got an extra boost towards the end of last week where Lebanon and Israel were going to have some ceasefire talks also. So that got everybody all excited on Friday of last week. And then Iran also said they were going to open up the Strait of Hormuz, and that just kicked off a real strong rally to finish up the week. And in fact, the Dow was up about 3.2%, but the Nasdaq 6.8%. So that was a big move. We had the S&P 500 close over 7,000 for the first time. In fact, I think it closed on Friday at 71.26. It was up about 4.5%. But we had new highs in the S&P 500, the Nasdaq 100, the Dow Jones Transportation Index, the Russell 2000, and the Philadelphia Semiconductor Index. And those last three, the transports, small caps, and semis, a lot of technicians like to see those secondary indexes lead the market higher. And that's what we're getting right now. In fact, yesterday, I wrote in the daily letter that the transports were up 4.1% yesterday alone. And because oil was up, I thought that was a little bit strange. But what's going on with the transports is you're seeing some of this very heavy equipment for the heavy transportation equipment. Stocks are starting to make a big run. They're starting to break out the new highs, and they're all trading in the $600 or $700 range. So that's pushing that a little bit higher. But anyway, also last week, we started getting a lot of the banks beginning to release their earnings. We had Morgan Stanley, we had, Citigroup, JP Morgan Chase, Bank of America, Bank of New York. They all had great earnings. Some of them were a little bit light. Wells Fargo was a little light on revenue, but several of the banks had record numbers. So we also had earnings from some of the tech companies, specifically ASML, which is a chip maker, and it had a blowout quarter and just said that demand for their chips are just through the roof. In fact, a couple of weeks ago on the Tech Talk, we talked about the semiconductors and how they were breaking out, and that was a group that you're going to want to own. And in fact, we had the SOXL, I think it's doubled over the last, that's the triple leveraged semiconductors. It's doubled over the last 2.5 to 3 weeks to $100 today. So anyway, that's something you want to look at. We also had some big gains in the Mag 7. All the big cap stocks came back. We had 7.5% spike in the semiconductor index. It was up 15% for the whole week. We also had consumer discretionary stocks got a big boost mainly from Tesla. It was up 14.8%, another big move. But just about across the board, we saw gains. Friday, we saw the oil come down. That helped everything take another move higher. Energy was down last week about 3.37%, and utilities were also red, but everything else had nice solid gains. We started out yesterday churning a little bit, and that's because if you read the weekly letter on Friday, that we're certainly overbought by just about any measure. You've had just this reversal off the low from about 2.5, 3 weeks ago. It's just been a straight up move in the different indexes. In fact, it's kind of incredible when you look at it on a chart. You can see over here on the opinion ratio that we have where we're upgrading everything to a buy. This is just a huge move that you see. You don't see a reversal like that very often, but you just take it when you can. I think people got a little bit overcautious when the Iran bombing started, and that maybe it sold off a little bit more than it should have. And then people jumped in, and this is mainly the institutions are definitely coming back in to buy, and that's causing this to come in. Plus, you're seeing a lot of buying now for the retail. But anyway, to go back here just a little bit, the semiconductor index was up about 7.5%. Communication services were big because you had Alphabet and Meta Platforms moving higher. And of course, the earnings from the banks helped the financial ETF, XLF, also outperforming. Now, this week, we are a little bit light on economic data. We had just had T-bill auctions yesterday. Today, we had retail sales for March, and they actually beat. They were up 1.7%. They were looking for up 1.4%. So that's helping the market today. Also, especially helping the consumer discretionary sector. Again, it's outperforming. Today, you also have, I guess, because of Intel and the semiconductors, again, you're having the XLK, the technology sector, outperforming again. It's strong. And of course, even despite the fact that energy or oil prices are up just a little bit, you have kind of a flat trading in XLE. Now, we started today with the health group, which is in the Dow. It had great earnings. 3M, not so much, but the stock was trading up. We have Tesla tomorrow. We have a couple other of the Mag 7 stocks reporting towards the end of the week. So not a lot of stuff going on except for the earnings this week, but it's still going to be a little bit off of the headlines. Now, yesterday was kind of a consolidation day where we saw that things just churned sideways, but ended up with marginal losses, which is kind of good. I mean, the Nasdaq was on a 13-day win streak. That was the longest daily win streak since 1992. Had it been up yesterday, it would have been the longest daily win streak since 1987. So things are looking good. With one mention about the earnings right now, 87% of the companies that have reported so far, the S&P 500, have beaten estimates. Now, normally you're going to see about 72, 73%. So this is quite a strong earnings period that we're in right now. I think that's surprising to some investors. We would be that strong considering all the stuff that's been going on over the last couple of months. You know, we had the tariffs going on and that kind of stuff, and then oil moving up and all that. But anyway, you just go with what's getting you there. And right now, earnings are taking the market higher. Now, as far as the technical condition of the market, like I said, that we are overbought by several indicators. The MarketEdge S&P short range oscillator, the SRO, which you often hear Jim Cramer talking about, that is his favorite oscillator in the market. It got up to 8.45 or something like that last Wednesday, I believe it was. Ended the period at around 789. Anytime you see that above 7, it's tough to be a big buyer in the market because you're so overbought that the institutional players, historically, they'll take a little bit off the table, figuring that you're going to get some churning or some backing and filling. And maybe that's what we're going to see a little bit this week because we've had such a big run. You also had stochastics, which they were up to 98, 99, which is, it only goes up to 100. And normally if they consider anything over 80, I consider maybe 90 to be really overbought. But everything you look at was overbought. Even the 14-day RSI was overbought. In some cases, you want to keep an eye on that. That's just a little bit more intermediate term, showing that we're overbought. One other thing I wanted to mention on the technical condition, two things that stick out to me right now that are a little bit concerning. Number one is with the Nasdaq on fire here with all the AI infrastructure trades, which is again leading the market higher. You're only getting 74 new highs on Wednesday, 79 on Thursday, 86 on Monday. Now, Friday, you did have 195 new highs on the NYSE. And you want to see more than that when you're breaking out with a big broad-based rally. And with the NASDAQ, last week you had 288 new highs on Tuesday, 333 on Wednesday, 527 on Friday. So the NASDAQ is showing good broad participation, and that's what you want to see. As it's leading the market higher, you're seeing more broad-based in that. I think a lot of that could also be people coming back into the software and all that. But I would like to see the NYSE start to show a little more oomph in the number of new highs. Today, well, there was up 300 some points when I last looked at the Dow, and it only has 138 new highs. Again, that's something you'd like to see that up into 250 or 300, like where we were back in February. The other thing that was a little bit troubling last week is you only had XLK, the technology sector, trading at a new high. If all the indexes are breaking out to new highs, you'd like to see most of the sectors participating in that. But technology is the only one making a new 52-week high. Communication services, which has Alphabet and Meta, it was close, and so was consumer discretionary. They're close to new highs. They may be getting there today, but that indicates a little bit of narrow leadership, which we need to watch over the next couple of weeks here, just to make sure that, because we want to see that broaden out if the market's going to continue much higher. Finally, investor sentiment, it's still regarded as neutral. We saw retail bulls drop down to 31.7 last week. It was just a small downtick. They've been below the historical average for the percentage of bulls now for 9th consecutive week. That's usually about 37.5% of the retail investors, according to the American Association of Individual Investors. Historically, that's what you're going to have. Now, as far as the professional investors go, we saw a nice big jump in the investment managers exposure index last week. It went from about 69.4% the prior week up to 79.5%. And I imagine we'll see that jump up in the high 80s this week because these numbers lagged just a little bit. It'll come out on Thursday of this week. So we'll see how they move on that. But, when you have about 30% of your money in cash, as they were, that's a lot of inflow that you're going to see as they come back into the market. And I think that's also helping to propel this thing straight up. Other than that, we did see the momentum index is still bullish. We're up to a positive +6. The CTI is bullish. It's going to remain bullish through April into May. We'll see how that goes. One of the things that I always look at, and we can check this out over here, is the NYSE advanced decline line, which market technicians always consider that a leading indicator for the market. As you can see, the advanced decline line, while this has been here, has been straight up also. And in fact, we made a new high last Thursday and Friday. And yesterday also we made a new high. And that's just something that you want to take a look at when you're looking at this thing. If you're thinking about buying stocks and the market's kind of going sideways or up slightly, that would be negative divergence. But this is just confirming the fact that people are buying stocks and more stocks are under accumulation than distribution. So that's a good sign. And you had the same thing with the Nasdaq. Now the Nasdaq is not considered quite the indicator of the NYSE is, and that's because you have more kind of junk stocks in the background of the Nasdaq. So sometimes people drop those off to buy better companies. So that's something that, again, confirming that the market is in an uptrend and we're still going to go higher. We often talk about the VIX when it crosses above 25, if it gaps above there, you want to start thinking about buying like it did over here. And that's where the market basically bottomed out. And now we've been moving here, and then we got the big gap down here a week and a half ago or so ago. And we're trading back down here below 20. I think yesterday we were at 1887, but Friday VIX was 1748. That was the lowest, I think, since February, if I'm not mistaken. So that's telling you that traders think the worst is behind us, basically, is what that's telling you. And that's a good sign. Now, this week, as we just mentioned a little bit ago, we do have a lot of earnings coming out. We're getting upgrades on price targets today. I just saw today, I believe it was Citigroup, moved Intel's price target after their earnings from about 69 up to a 95 or something like that. So the firms are expecting earnings to continue going forward. We're not seeing the companies reporting, very many of them say that things are slowing down all that much. And we're also today watching Kevin Warsh, I believe he's having his confirmation hearing today. And of course, he is considered a little bit more of a dove on interest rates, which if he does get confirmed, you may see maybe not much of a move in rates, but you will probably see the forward CME group, FedWatch, start to project a little higher chances of rate cuts in the future. About two or 3 weeks ago, we were at 0. I just saw this morning, I think December is priced in for a cut. Maybe they'll start looking at something else. And we have to watch. They're supposed to have the talks on the ceasefire tomorrow with U.S. and Iran. Of course, they're doing their saber rattling right now. We'll see how that goes. Trump saying he's not going to extend the ceasefire if they don't come to the table, that kind of thing. And of course, that can change the outlook very quickly if they start dropping bombs or something like that. And so you have to be aware of that. However, as we've seen the last couple of weeks, even when that was going on, that doesn't necessarily affect a lot of companies over here in the day-to-day. Gas going up is something, but for most people, it's not going to be that big of a deal breaker where they're going to change their style of living or anything like that. So I would stay invested. I would look at maybe buying the dips if we get some headlines that knock the market down. And from there on, I think things look fairly bullish from here.
Very good. Thank you, David. Is there anything else our viewers should take note of before we head out?
Today we're having another big day today. I'm kind of surprised that we're getting this big of a move because, as I mentioned, the SRO had gotten up to 837, and we did some work on that. And I think going back 20 years or whenever it got above that, 30 days after it had gotten that high, the market was only up about 1.8% 30 days later. We're probably already past that here in the week since that's occurred. So this is uncharted territory that we're seeing with this market advance at this stage. And that's just what they call it, FOMO, fear of missing out. Perhaps you're getting some of that, which usually when you have a big spike like this, the market goes higher than what it normally should do. Just like on the downside, when people start to freak out a little bit, it goes a little bit lower than it probably should to the downside also. So yeah, I would not be jumping in here on buying anything, but I would look at to buy the dips on things that as we go forward here, if you get some headline risk going up and down.
Great. That's it for this week. If you have any questions for David or anyone else on the MarketEdge team, feel free to reach out by sending an email to support@marketedge.com or drop a comment below if you're watching on YouTube. If you'd like to try MarketEdge, your first 2 weeks are free. Give us a try at marketedge.com. That's it for this week. We'll catch you next time. Thanks, David.
All right. Thank you.